Hello everyone, and welcome to another exciting interview by Financial Insight. We are currently at the AfricaWorks branch right here in Agora Village in Lusaka, Zambia, where we're about to have another update from our friends from Finwise Analytica. Yes, Chiti is back with us to tell us about the Q2 report and obviously to discuss exciting things in terms of how our banks perform. So stay tuned for this interesting interview taking place right here at AfricaWorks Agora Village in Lusaka. Welcome back. As I'd indicated, we've got Chiti, who's joining us from Finwise. Chiti, welcome back to the Financial Insight Show.
Thank you. Well, it's a pleasure to be here.
It's always an honor to host you. And as we always like to find out, how things going at Finwise, eh?
No, pretty much well. We've just released the Q2 banking reports. We've added in other insights that were not there in the previous editions.
Absolutely.
And really, we are looking forward to disseminate this information to the stakeholders.
Absolutely, and I just got my copy today, and thank you so much, Chiti, for sharing. It just goes to show, and it's a testament in terms of what we're trying to build here. Exactly. With both our brands in terms of having thought leadership around banking. But before we get started with the main questions, are you able to just give us an overview summary of what people can expect out of the Q2 report on banking?
Thanks, Mwelwa. So some of the things or metrics that we've added in this report include items like Jaws ratio, which were not there in the previous editions. So Jaws ratio just tells you at what rate is your income growing versus at what rate is your cost growing. Okay. But also importantly, we've added metrics that talk about when was this bank incorporated. Okay. So we've got some banks that are leading, but maybe have been in this country for 50 years. Okay. And we've got a bank, for example, that is in the mid-tier, but has only been in this country for 17 years. So we've created metrics that says, if we ignore the year that the bank was incorporated, who is performing at what level? And what that does, it tells even those that are leading that within a short space of time, the other banks that are lagging might actually catch up on them. So we introduced profitability based on the year that the bank was incorporated. We've introduced deposits based on the year that the bank was incorporated. Wow. And interestingly, actually, the numbers flip.
Really?
When you rank it like that.
Wow. Now exactly. that's obviously quite fascinating. Now, just before we get into it, what from your analysis, what were some of the major shifts that you've seen in the sector between Q1 and Q2 2025, and that industry players should obviously take note of?
Thanks, Ray. So, from an industry perspective, we have seen that PAT, profit after tax, has remained stagnant. So Q1 profit after tax for the industry was 2.5 billion. Q2 profit after tax remained flat at 2.5 billion, giving HQ1 of 5 billion. What we've also seen is that the top positions have also changed.
Like musical chairs.
Exactly. So Q1 we had ABSA as the leader. Q2 year to date we have Stanbic that is leading, and then ABSA second, and then we have Zanako number 3 in terms of profitability. But we've also seen a shift in terms of 7th and 8th position. Okay. So we now have Citibank that is 7th. Last quarter was 8th. Okay. And they've swapped places with Stanchart. Okay. If we go to 13th and 14th, we also, it's just swapping basically. Okay. So we also see ZICB coming in on 13th position, swapping with AB Bank that has gone to 14th position.
Wow, that's quite remarkable. Now, we had a snippet of the report, and one of the things that we're observing is that the industry profit after tax rose by 24% year on year to about 5 billion, and revenue jumped by about 17% to nearly 15 billion, and deposits reached 210 billion. What do these growth numbers say about the overall direction and strength of the Zambian banking sector?
Thanks. I think what we see, and maybe to answer that question, I'll go back like 4 years. What we see is this is the first time that the industry has reached 5 billion in terms of profitability. If we go back 2 years ago, that number was static. So 2024, the industry was at 4 billion. 2023, the industry was at 4 billion. If we go to 2021, the industry was at 2.3 billion. So already we can see that the industry is resilient and it's adequately capitalized if you look at the capital adequacy ratios. But also what is important is the efficiencies we are seeing in the industry, right? Because when you look at revenue, when profitability was 2.3 billion, that is 4 years ago, the profitability for the industry was 8.3 billion. Right now, the profitability for the industry is 14.9. Rather, the revenue in 2021 was 8.3 billion.
Right.
Profitability was 2.3. Right now, revenue is 14.9 billion. Profitability is 5 billion. If you look at the growth in terms of revenue, it's about 80% growth.
Wow.
But if you look at the growth in terms of profitability, it's about 117%, somewhere there. So that tells us that revenue is going up. Then you've got this other element called costs, but costs are coming down.
In an inflation,
Exactly.
That's quite curious.
So the rate at which costs are going up is not the rate at which revenue is going up. So revenue is outpacing costs. And we can actually see that in the cost to income ratio. So for every 100 Kwacha that the industry made in revenue in 2021, 57 Kwacha went to costs.
Wow.
Today, for that same 100 Kwacha, only 52 Kwacha is going towards cost. And that tells us that the industry is also finding ways of being efficient. So they're not just growing revenue, but they're also managing the costs pretty well.
Right. Now that's obviously very, very interesting. And could that also maybe, by and large, be also attributed to the musical chairs we're seeing? Because, obviously at Q1, we saw ABSA, the leaders indicated, but now Stanbic has obviously, taken the leaderboard. What are some of the key drivers that are fueling this performance?
Yes. So for example, if we look at Stanbic, right? And when you look at the top balance sheet players, you have Zanako, you have Stanbic, predominantly Zanako. If we go to the sources of operating income, where are these banks? Where do they generate the most income?
Correct.
The top three banks, their biggest sources of operating income is interest income from loans, then interest income on investment securities, and then you have FX income, and then commission and fees. And you find that the FX income and commission and fees will, other banks, FX income is the third. For other banks, you'll find that fee and commissions are the third. But predominantly, these are the key drivers of operating income. So if we go to interest income from loans, you'll find that on a quarterly basis, out of the top three, only Stanbic recorded only Stanbic was flat. The other two reduced their balances on loans and advances on a quarterly basis. So Stanbic maintained their loans and advances balances, whereas Zanako and ABSA reduced. So that gave, and Stanbic has a healthy net interest margin, so that gave them an uplift. But what is also important is that Stanbic had the highest increase in terms of non-interest revenue on a quarterly basis. So your non-interest revenue are the things we're talking about in terms of FX income and commission and fees. And they posted, on a quarterly basis, they posted the highest growth. And that is what pushed them to be number one. But also is, because you can push your revenue up, but the question is, are you managing your costs?
Correct.
And that is one other thing that we saw Stanbic do in terms of their cost to income ratio came down by about 300 basis points, which actually helped them to move to first position.
Right.
Exactly.
Now, we turn ourselves to Zanako. It continues to dominate in deposits and net interest income, yet reduced its lending in Q2 and remains the biggest spender in terms of costs. What does this say about its market strategy and cost drivers and risk appetite?
If we look at Zanako, I think Zanako is a special case, right? And I say this because Zanako is the leader on pretty much most of the balance sheet metrics. So deposits, loans and advances, investment securities, even in terms of revenue. But Zanako issue is on the cost. So if you look at cost to income, Zanako's cost to income has gone up from about 58% to 61%. Right. But it's find itself in a very unique position. And the reason I say that is, if you look at the other top four players, you'll find that the top four players have got a group, which I would even say a strong group, which is also a banking group, right? So with that comes certain efficiencies, certain skills, certain businesses, certain expertise. So you find that, for example, the head count of Zanako would probably not be the head count of the other banks that have a group somewhere. Because they have these shared resources that they use across the group. And also the fact that if you look at Zanako in terms of its interests, so you've got government there. So you may find that the objectives of government and the private shareholders somewhere in South Africa might be a little bit different. So even where Zanako would want to put in some certain efficiencies or strategies, you may find that probably those conflict with some objectives of government. So I think they find themselves in a very unique position. But if you just look at the numbers, for example, Zanako has one of the highest loan-to-deposit ratios, so which actually means that they're deploying capital towards loan. They've got healthy net interest margins. They are posting. They've got a very healthy jaws ratio as well. So the biggest issue is cost, and I think cost is because of where they are. So I think we really can't compare Zanako with the other pack because of those that unique circumstance that they find themselves in.
And that's obviously quite significant and a very interesting observation. When it comes to the banks, which banks currently combine strong profitability and robust balance sheet strength, offering the best overall value to investors and customers. Particularly when you assess them on a tier-by-tier basis, which ones performed the best?
Perfect. No, thanks, Mark. So if we look at the entire industry, we've got 15 players. And I must mention that we've seen mixed performance. But if you look at it, for example, on a year-to-year basis, we've seen that all the banks are posting gains from a profitability perspective, from a revenue perspective. But one bank that we think the other players have to watch out for is FNB. Right, and we've done a deep dive amongst other banks, But when you look at FNB, FNB has consistently been number 4. Consistently been number 4. If we go back 4 years back, FNB's share of wallet in terms of profitability was about 7%.
Okay.
Q2 right now, it's 12%. That's profitability share of wallet.
Okay.
If you look at their cost-to-income ratio, their cost-to-income ratio is improving consistently. But also, what we see is that their JAWS ratio, the rate at which income grows versus cost, is also improving consistently. But one of the other important metrics, Mwelwa, is we then said, can we look at the years that this bank has been in existence?
Right.
And then we did, okay, fine, because balance sheet tells us from day of inception to today, how much are your deposits, for example.
Correct.
And then we said, okay, fine. So can we find out per year that this bank has been in existence, what that translates to?
Right.
If we take out Access Bank because of the acquisitions that they did, you've got Finance Bank, you've got Atlas Mara in there, you've got Cavmont Bank combined in that acquisition, you will find that FNB tops the list. So for every year that they've been in existence, FNB tops at $1.1 billion. 1.1 billion Kwacha in deposits.
Wow.
The next bank, if we remove Access, Access is the top at 1.14, but because of the acquisitions, you'll find that the next bank is 0.68 billion.
Quantum.
And that's a quantum.
Yeah, that's quite a quantum.
And that will be your Stanbic and Zanako at 0.68. If we go to profitability and say, okay, for every year that these banks have been in, we divide that by profitability, you will find that FNB is at 35 million Kwacha for every year that they've been in existence. The next bank is Stanbic at 18.5, which is more than double.
Yes.
So what that tells us that if FNB continues at this pace, all things being equal, if all the banks grow the same way they're growing, we will find that what we're calling the Champions League will probably now have 4 players.
Okay.
And not 3 players.
Okay.
Because for every year that they've been in existence and they are growing organically, we are seeing that they are the ones that are leading this. So they are maximizing, they're optimizing every year of existence, if we can put it that way.
Absolutely,
Exactly.
absolutely. But anyway, obviously, I'm very curious now to see, what did you see with the Champions League? The top 4 or 5 banks, what are we seeing at Q2?
So at Q2 in the Champions League, we still have your top 3, Stanbic at 1 billion. Then you have your Absa and Zanako 800s, and then you have FNB, which is in the 500 million range. But we still see the same structure in terms of the top 3.
Okay.
Leading the pack, and then you have your FNB, Indo, and then Access in that second tier, and then you have your mid-tier, your Citibank, Stanchart, and then probably the last tier, where you have your ZICBs, First Alliance, and them. Yeah.
Right. Right. Now, obviously, when you look at the leaderboard, why should bank executives, employees, investors, and policymakers access this particular report, and what additional insights can they expect, especially at this particular point where you've made certain improvements, you've added on a couple of more insights? What is like the general broad scope of what we're trying to communicate in this report?
Thanks, Mwelwa. So if you look at, for example, some of the metrics that we've added, it includes things like the run rate. So it gives a sense of where do we expect the bank to close at end of the year if we continue running at this rate.
Okay.
Now we've added metrics like Jaws ratio, we've added metrics like the deposit per year and things like that. So what that does is that instead of having information in bits and pieces, you have everything in one report. You can actually see where your competitors are missing it. You can see what you're doing well, and that helps shape strategy because you can clearly see that, for example, our cost-to-income ratio needs improvement. We've gone behind in terms of revenue growth. So it gives a year-on-year comparison.
Right.
It gives a quarter-on-quarter comparison, but it also gives 4 years year-on-year growth rates across different metrics. So we combine everything and show it in one in one report that makes it easier for decision makers to make decisions. And also not just for executive, we've also seen that the report has received a lot of overwhelming response from the employees themselves of the banks.
Okay.
Yeah, so they're following the report closely, and I think it's helping shape behavior as well, because each employee can see what their contribution is adding in terms of the ranking and profitability and the other metrics.
Absolutely, absolutely. Obviously, half year is done now.
Correct.
What is the forecast for Finwise over the next coming months? We know that obviously there will be the 2 subsequent reports, etc.
Correct.
But what are you and your team going to be busy with going forward?
So going forward, tomorrow we'll be releasing the Microfinance Institution Report.
Wonderful.
Quite some insights we're already seeing there.
Okay.
So
and we can't wait to dig in as well. Yes. So we will be. So stay tuned. We'll be bringing the gist, as it were, the corporate gist from that report as well.
And we're seeing quite some interesting dynamics in terms of the microfinance space, but also just in terms of the banking industry. So in the subsequent reports, we're going to add comparisons between MFI and banks. So for example, we are seeing a shift in terms of consumer lending, shifting towards microfinance institutions, away from the banking space. So we want to bring in all those aspects so that decision makers can actually see that they're not just competing with banks, but they're also competing with other players in the non-bank financial sector.
Absolutely, absolutely. Chiti, thank you so much for sitting down with us. It's always insightful getting these updates.
It's a pleasure to be here.
Absolutely.
Thank you.
Absolutely. So there you have it. We've just watched the Q2 update on the performance of Zambia's banks. So stay tuned for more insights. And as you've heard, the MFI report is also out. So look out for it coming out in the next couple of days or weeks. I've been your host for this particular interview, Mwelwa Kenneth. Stay tuned for more insights on the Financial Insight platforms, as well as following all our channels, the YouTube platform, Facebook, LinkedIn, X, all the social media platforms, and our flagship website, www.financialinsight.africa. Stay tuned for more insights and get to know.